Most investors are losing money they don't know they're losing. Not to bad picks, not to a crash, to a number so small it doesn't feel worth worrying about. And because it's quiet and automatic and invisible on any given day, most people never connect it to the gap between what their portfolio should be worth and what it actually is. Here's what that gap looks like in real numbers. Take $10,000, invest it for 30 years. The market returns 7% annually. In a low-cost index fund charging 0.04%, you end up with roughly $76,000. Same $10,000, same 30 years, same 7% market return, but you pay 1% annually. You end up with roughly $57,000. The fee didn't cost you 1%, it cost you $19,000 on a $10,000 investment. Scale that up. $100,000 loses roughly $190,000. $500,000 loses nearly $1 million. This isn't a projection, it's compound interest applied to a fee, and it's happening quietly, automatically, every single day. But here's the thing, fees are not the most expensive mistake most investors make. Over the past 2 decades, the average U.S. equity fund returned roughly 8% annually. The average investor in those same funds earned roughly 6%. Same funds, different behavior. That 2% gap compounds for decades. On a $500,000 portfolio over 20 years, it adds up to roughly $600,000. Not lost to fees, not lost to fund selection, lost to decisions, buying after rises, selling after declines, waiting for clarity that never feels sufficient. The fund didn't fail, the investor did. And before you continue, answer this honestly. If your portfolio fell 40% tomorrow and stayed down for 2 years, would you hold or would you sell? Write down your answer, because the rest of this is about the gap between what you just wrote and what you would actually do. That gap is where the $600,000 goes. There is a portfolio structure designed to solve both problems at once, the fee problem and the behavior problem. It requires 3 funds. It takes about 30 minutes to set up. And the reason most investors fail to capture its full return has nothing to do with picking the wrong funds or setting the wrong allocation. It's that the strategy works by removing the decisions most investors think they need to make. And removing decisions feels uncomfortable, right up until the moment the market drops 40% and you realize the decision you most needed protection from was your own. Here's how it works. The first fund owns virtually every publicly traded company in the United States, large, mid, and small. Not just the S&P 500. The S&P 500 is 500 companies. The total market is roughly 4,000. Small and mid-caps behave differently than mega-cap stocks. Some of the strongest historical periods were driven by companies outside the top 500. Owning the total market means owning all of it. Cost, somewhere between 0.00% and 0.04% annually. The second fund owns companies outside the U.S., developed markets, emerging markets, roughly 8,000 companies across 40-plus countries. The objection arrives quickly. The U.S. has outperformed for 15 years. True. Before that, international outperformed for much of the 2000s. These cycles don't announce themselves. They don't repeat on schedule. They don't ask for permission before reversing. The U.S. represents about 60% of global market cap. International represents about 40%. Owning only U.S. stocks isn't a neutral position. It's an active bet disguised as a default. Holding both means you never have to predict which region leads next. The third fund owns government bonds and investment-grade corporate bonds. Lower return than stocks over long periods. That's expected. Bonds are not a return enhancer. They're a behavior enabler. They do 2 things. They reduce how far your portfolio falls in a crash, and they give you something to sell when stocks are cheap. In 2008, stocks fell roughly 50%. A portfolio with 30% bonds fell significantly less. The investor who could tolerate a 30% decline stayed invested. The investor who couldn't tolerate 50% sold. Same strategy, very different lifetime outcome. Bonds exist to make staying invested survivable. Now here's what most people miss about this portfolio. The 3 funds are not the point. What they do together is the point. And the most important thing they do together is this: they remove decision points. No sector rotation, no fund swapping, no economic forecasting, no chasing last year's winner. You set an allocation, you automate contributions, you rebalance once a year, you hold. Every decision eliminated is a mistake prevented. The fewer choices you're allowed to make, the less damage you can do to your own compounding. That is the real edge. The diversification matters because combining assets that don't move in perfect lockstep reduces volatility without proportionally reducing return. It's the closest thing to a free lunch in investing. The low fees matter because active management is a zero-sum game before costs. After costs, it becomes negative sum. Over 10 to 20-year periods, 80 to 90% of active funds underperform their benchmark after fees. Not because managers are incompetent, because markets are competitive. Indexing opts out of the competition entirely. But neither advantage survives bad behavior. The low-cost diversified portfolio only works if you stay in it, and staying in it is harder than it sounds. Before you build the portfolio, two decisions. Write them down. Do not revisit them based on headlines. The first is your stock-to-bond ratio. Forget rules of thumb. Ask this instead. What is the highest equity percentage I could hold through a 50% decline without selling? Because 50% declines are not rare accidents, they are recurring features of equity investing. Lower equity held consistently beats higher equity abandoned at the bottom, every time. The second is your US to international split. Start with 30% of your equity allocation in international. If you deviate from that, write down your reason. If the reason is that the US has outperformed recently, that's not analysis. That's recency bias dressed up as conviction. Once you have those two numbers, add one rule. Once per year, if any allocation drifts more than 5 percentage points from target, rebalance back. That single rule is mechanical: buy low, sell high. No predictions required. Write it down with your allocation. Follow it without thinking. Now we get to the part that actually determines your outcome. March 2020. The S&P 500 fell 34% in 33 days, the fastest bear market in history. Millions of investors who understood passive investing sold anyway. Not uninformed investors, informed ones. The market recovered within 5 months. Those who sold missed some or all of it. And here's what that moment actually feels like from the inside. You don't think, "I'm panicking." You think, "Risk has structurally increased. My thesis is invalid. Reducing exposure is the prudent move." It feels analytical. It isn't. You cannot fix this with more information. More information is what made it feel analytical in the first place. You fix it with structure that operates when you can't. 3 structures that work. The first is a written premise. Before you invest, write down 4 things. Why you own global equities, why you hold bonds, your exact allocation, and the specific condition that would cause you to change it. A price decline is not a premise failure. A recession is not a premise failure. A bear market is not a premise failure. Structural breakdown of the profit-generating capacity of global capitalism would be. Short of that, volatility is noise. Print it, sign it. When markets fall, read it before making any decision. Then ask yourself one question. Has the premise failed, or has the price fallen? Historically, the price fell. The premise survived. The second structure is automation. Automate your contributions. Automate reinvestment. Remove timing decisions entirely. Think about what that actually eliminates. Every month the market is down, you would have hesitated, wondered if now was the wrong moment, told yourself you'd wait for clarity. Automation removes that conversation entirely. The contribution goes in whether the market is up, down, or in free fall. You never get to second guess it because there's nothing to second guess. The question, "Is now a good time to invest?" disappears, and with it, one of the most expensive habits in retail investing. The third structure is the 72-hour rule. Before making any allocation change during a crash, read your written premise. Then wait 72 hours before doing anything. Here's what that window actually looks like. Day 1 of a significant market drop. The feeling is urgent. The thesis feels broken. The losses feel permanent. Every instinct says act now. Day 3. Something has shifted. The urgency has softened. The losses are the same, but they feel less final. The decision that felt obvious on day 1 now requires justification. Most decisions that survive 72 hours are rational. Most decisions that don't survive 72 hours were impulses. The rule costs you nothing when markets are stable. It saves you an enormous amount when they aren't. The rule costs you nothing when nebulous times come. Phase you an enormous amount when necessary. Just sits and sing. A The rule costs you nothing when markets are stable. It saves you an enormous amount when they aren't. Here's the full picture. The three-fund portfolio works, not because it's clever, not because it predicts anything, because it minimizes fees, concentration, and decision-making simultaneously. It reduces the number of ways you can damage your own compounding. You are not just building a portfolio, you are building a system that protects you from yourself. The math of low-cost diversification is simple. The behavior required to capture it is not. Build the structure before you need it. Because when the market falls 40%, and it will, you won't rise to the level of your knowledge. You will fall to the level of your system. One question for the comments. Think back to March 2020 or 2022 or any period when your portfolio was significantly down. What did you actually do? Not what you wish you had done, what you actually did. Drop it below, because the gap between those two answers is the most expensive number in your financial life.